Amanda Crowther here from Simple Acquisitions. Today we're going to talk about real estate depreciations and what exactly investors can cheer about. I originally had this 2, 4, 6, 8, what can we depreciate? I think Mark thought that was a bit corny. So it's hard to come up with a cheer for depreciation, but it's something that many real estate investors like to celebrate. Real estate depreciation is a well-known concept in the investing world, and as you learn how to invest in real estate, you'll discover that surprisingly not everyone takes advantage of it. For some, that is a strategic choice, and for others, it's simply because they don't know about depreciation. Before I dive any deeper into this video, I want to start by saying that we here at Simple Acquisitions are neither accountants nor do we provide accounting or tax advice. This video is for educational purposes only, and is to provide an overview of the concept and to show you how useful it can be to help build wealth. It's always recommended that you consult with your CPA or other professionals when making decisions about tax matters. Now, for those who are unfamiliar with this deduction, in simple terms, real estate depreciation is a gradual decrease in the basis of a property over time. Like with almost any asset, as a property ages, it deteriorates. The IRS permits you to deduct an asset's cost over its projected useful life on an annual basis. This activity reduces the taxable income without reducing the cash on hand. Depreciation is a non-cash expense, so this means it increases free cash flow while decreasing reported earnings. Can you see why many investors apply this tax deduction? So what can be deducted? Well, depreciation is not isolated to only the real estate. However, for the purpose of this video, we're going to focus on real estate depreciation. With respect to an income-producing property, you can also depreciate tangible items that last for more than 1 year. So this would include things like stuff inside the rental units like stoves, refrigerators, furniture, and carpet maybe. Equipment used to run your investment property can also be depreciated. Some examples of those would be computers, cell phones, and fax machines. An important thing to note is that land is not depreciable. Only the buildings and its contents. Hence, when you're doing calculations, the land value has to be extracted out. To add another twist, although you cannot depreciate the land, you can appreciate the landscaping. So if you made improvements to the rental property, you can continue to depreciate the cost of those improvements. Real estate depreciation is a non-cash deduction, so expenditures are not required to claim it. A building and its contents depreciates whether or not the property owner claims them. So what are the requirements? So as per the Internal Revenue Service, our favorite organization, the IRS, you can depreciate a property if it meets all 4 requirements identified below. 1, that you are the property owner. 2, the property is used in your business or income producing activity. 3, the property has a determinable useful life. And 4, the property is expected to last more than 1 year. So how much can be depreciated? The IRS also determines how much depreciation can be deducted annually. It all depends on the following. 1, your basis in the property. 2, the recovery period for the property. And 3, the depreciation method used. The IRS also determines how long an asset can be depreciated. There are specific parameters and timeframes established. I'm not going to go into these here. Depreciation is initiated when it is placed in service as an income-producing property. It ends when the costs or other bases have been fully recovered or when it's retired in from service. The IRS defines retired from service as the following. You sell or exchange the property. You convert the property to personal use. You abandon the property, or the property is destroyed. When selling the property, you need to take the depreciated deductions into account when calculating the capital gains. Those capital gains, however, can be deferred via what's known as a 1031 exchange, but we're going to save that conversation for another day. Stay tuned for an upcoming video where we're going to review another key element of depreciation, which is called the segregation study. As you can see, there are many factors that come into play with respect to depreciating an income-producing property. Seek professional advice, and you might be able to take advantage of these deductions that can help shelter your income from taxes. This in turn leaves more money in your pocket, and as a result, you get closer to financial freedom. Simple Acquisitions is a real estate syndication company, so if you participate in a syndicated opportunity, you as a private lender partner not only receive a return, but also a share in the depreciation as well. as well as other benefits. To learn more about that or how investing can benefit you, then get in touch with us. Remember, real estate doesn't have to be complicated. With simple acquisitions, it's smart, secured, and simple. That's it for me. Thanks for listening.